Welcome to another public live stream session. And man, am I super fired up to talk about the financial independence strategy and how to start your FIRE investment journey from $0. So let me go ahead and mute this real quick. And while you're watching this, you can download your free financial resources by visiting firestation.com/resources. And some resources in this video are only going to be available to the course members in my private group. And if you're watching this from my private community, you will get the latest version of all of the spreadsheets I'm going to show you today. And if you're interested in joining my private community, you can visit firestation.com/community to start a free trial today. And you can also schedule a 60-minute session with me by visiting firestation.com/consultation. And on Saturday, my channel reached 40,000 subscribers, and that's after being monetized 2 years ago. So I can't thank you enough for your continued support. And I promise to continue delivering the content you need to help you achieve financial independence so that you have the possibility to retire early. And I also want to say thanks to the people in my private community for their above and beyond support of me and my channel. And you should see how many of my clients became debt-free and achieved their first $100,000 in their investments. And they all got my trophies for their special milestones. And you can visit firestation.com/community to get your free trial right now. And you can cancel it anytime. And if you're one of my channel members, go to the community tab on my YouTube channel and you'll see the members only post about the discount code, and you'll get the entire month off for the private community. So be sure to check it out when you get a chance. And this is going to be a beast of a live stream. So I'll be sure to leave chapters in this video if you're watching this on replay. All right. So with that being said, clear my throat and let's get started. Okay. So calculating your net worth is like going to a doctor's office to get your annual health checkup, but you're doing your annual financial checkup. Just for the private course members, you're going to be able to download the latest and greatest net worth calculator in the private community. So let me show you this here. And calculating your net worth is easy, but complicated at the same time. You have to first assess where you are with your finances. Do you have more assets or liabilities? Do you have too much cash and not enough retirement? Or do you have too much real estate and not enough taxable investments? And at the top of the spreadsheet here, you're going to see that the mortgage, or we'll get to that actually before that. The top of the spreadsheet is where you want to enter the date here. Okay, so that will be today's date on the date that you do your net worth statement for accuracy. And you don't need to do another one for another year, but it's up to you if you want to do it every month or every quarter. It's typically done annually. And the first block is where it says mortgage right here, right? And that's where you put your current mortgage balance. And if you don't own a home, then you just put 0 right there. And if you have any other debt, this is where you enter all of your debt under liabilities. And you can select from investment mortgage, HELOC, student loan, personal loan, or car loan. When you enter the amount here, just make sure to put the negative value in the cell. So if you owe $200,000 on your mortgage, then put negative $200,000 in the cell. And then down here is where you put all of your assets from cash, retirement, taxable investments, vehicles, and real estate. Under the asset type, these selections are coming directly under here. Okay. So you can make changes to the asset types if you want to. If you don't have kids, then just delete kids down here. And you can always add more if you want to. And you would put the dollars in these cells in positive value. So if you have, say $5,000 in primary checking account, then you just put $5,000 here in positive value. And these are just all examples. And at the bottom of the spreadsheet here is where you have the asset allocation. And in this scenario, you have 11% cash, 25% taxable investments, and 35% retirement, and 25% in real estate. And this is going to give you a better idea of how much of your assets are allocated. Are you too heavy in real estate? Or are you too heavy in cash? Maybe you don't have enough saved in your retirement. This spreadsheet can help you or give you a proper diagnosis of where you are with your financial health. And if you need more rows, just you can just unhide them on the left-hand side here of the spreadsheet, okay? And then the next time you do your financial health checkup, whether that's a year from now or a quarter from now, you're going to put the date at the top in, let's say, in August 7th, 2025. And you can always set a reminder on your phone so that you don't forget about it. And let's say your mortgage is paid down to, let's say, negative 190. Oh, you know what? Can I do that? Let me see. Is there an error? I don't think I can make the error. Ooh. Yeah, I can't make any changes on this. But if you put negative $190,000 a year from now, the spreadsheet will automatically calculate that you have $10,000 in year-over-year changes, or if it will be a 5% decrease in liabilities. Pretty neat, right? And you can do the same thing with your assets here. So if your Roth IRA balance is now $25,000, then you have a $10,000 increase or a 40% increase year over year. But what if your Roth IRA balance decreased to, let's say, $14,000 here? Right? Oh, that's not, there you go, $14,000. Then you have a $1,000 decrease or a 7% decrease year over year. And you can see a decrease in balances, especially during a bear market. And let me see if I can change it here. Nope, I cannot. Oh, man. I forgot to probably just unlock it here. Or this is going to be on assets. You know what? Let me see if I can pull up Excel here. Okay, let me see if this is going to work here. It should. There we go. So it works on the Excel one. So I'll make sure that you guys can see it. But if you type in $190,000 for the mortgage right here, you're going to see the increase, right? And or decrease in liabilities. And then when you look at Roth IRA, you have a $10,000 increase. That's going to be a 40% increase year over year. And if you had a, let's say, a decrease in value because of the bear market, and now you'll see that 7.1% decrease year over year. And at the bottom of the net worth here, and it'll tell you what changed from a year ago or from the last year you made your net worth statement. And at the top of the net worth statement, you're going to see your total net worth and how much of it has increased or decreased year over year. So if you look at it here on the right side, let me see if I can draw this here. Maybe I can't. Let me see. Can I draw? Okay, so you see that right here. This is going to be 413,000 and then $9,000 in net worth changes. Okay, so if you can see that clearly, I'll make sure to drop this file in the private community, and then you can go ahead and download it from there for the course members. Anyway, so why is this important? Knowing your current net worth will give you a better idea of the direction you need to take going forward. Maybe you need to work on boosting your cash reserve or paying off your high interest debt. You can't possibly increase your savings rate until you eliminate your debt. And if you have a debt that charges you 5% or higher, you need to consider that a high interest debt because you're not going to be making any progress by investing extra money you get from your income. And that's the exception is your mortgage. Being debt free, except for your mortgage, is the fastest way to grow your assets. And your savings rate is always going to matter more than the stock market return. You can control your savings rate, but you can't control how the stock market performs, right? So the next one I want to show you here. Okay. And this is a very simple calculator where you can measure your savings rate. And your savings rate, again, absolutely matters more than the investment returns. It's not about getting that 8%, 9%, or 10% return on investments. It's about increasing your savings rate to the maximum so that you can achieve financial independence and retire early. At the bare minimum, you want to invest up to the employer match if you're still in debt. When you're out of debt and have some cash reserve set aside, then you want to go absolutely ham on your savings. It's not about saving 25% of your income towards retirement anymore. It's about maxing out your retirement vehicle up to the IRS limit. I don't even ask what the percentage is because I care more about what I can do now to max out every retirement account every year until my early retirement. And if you're not in a position to max out your retirement investments, then you need to prioritize paying off your debt or increasing your income. So if you have any profit sharing plan or some type of employer match, then you want to at least contribute that to the minimum, right? And if your employer contributes 5%, if you as an employee contributes 5%, then 5% should be the minimum you contribute to your 401k or 401k type plan, like 403b, TSP, or something else. And if you're a self-employed individual with no employees, you can contribute to a solo 401k as an employee and an employer. And then after the employer match, the next one I prioritize is the HSA, or health savings account. And this account requires you to have a high deductible health plan, and I will talk about that, the eligibility later on. And I treat my HSA like a separate retirement account because I can contribute to the HSA in pre-tax dollars, invest that money into an index fund, and then take the money out tax-free if they're for qualified medical expenses. And after I turn 65, I can use the HSA money to pay for any expenses. It's almost like a combination of a traditional IRA and a Roth IRA, right? And speaking of a Roth IRA, I will never miss out on a Roth IRA contributions ever again. And I used to miss them out, but I'm not going to do that ever again. Let me see if I can pause that right here for the Roth IRA. Okay. And that's during my FIRE journey. And I can use my Roth IRA contributions in my early retirement instead of waiting all the way until I'm 59 and a half. And you can see that the Roth IRA and HSA combined will only be about 9% of your total income if you make over $125,000 a year in salary. And I get that not everyone is making $125,000 right now, but if you're starting with 70,000, let's say, then you can start with HSA and Roth IRA and with the 401k up to the employer match. If you can't max out your HSA, then try maxing out your Roth IRA. Then the next one is maxing out your 401k. Just by maxing out your 401k, that's about 18% of your gross income at $125,000. Again, this is assuming that you're debt-free except for your mortgage. So once you're done with your HSA, Roth IRA, and 401k, then you'll need to figure out how much of your income can go into the index funds inside your taxable brokerage account, right? Could you start with 10% of your income? And what if you increase it to 15%? And if you take a look at the bottom of the calculations here, as a single person, you could save up to 30% of your gross income towards your HSA, IRA, and 401k, making $125,000 a year. And if you contribute an additional 10% to your taxable brokerage account, then that's going to put you at 40%. Could you save 50% of your income? You have to be the one to make those calculations based on your current expenses. Make sure to have some fun money set aside so that you can have that balance between FIRE and living in the moment now. And I purposely left out the spouse's savings rate until now because I wanted to show you what your savings rate would be like just based on one person's income. So if your spouse is also making money, and let's say about $100,000 a year, the total savings rate would be reduced to 18% with just the first spouse's HSA, Roth IRA, and 401k, right? So what if I start adding an employer match here at 5% and another, say, HSA at 4150, and let's put another Roth IRA at $7,000. That's going to be another 25% of the total gross income between Roth, not Roth, but both spouses. And if the spouse also maxes out their 401k, that's a total of 35% savings rate between both spouses. How incredible is it to save almost $80,000 a year just in retirement, right? And saving an additional 15% or $33,000 a year to the taxable brokerage account would put you at a 50% savings rate. Could you save more? Absolutely. But it's going to depend on the total household expenses. If you're in a position where you and your spouse both work, you have the best opportunity to save and invest 40, 50, or maybe even 60% of your total combined income. Some people invest 50% of their income for a few years and then reduce the savings rate because once they reach that number, whatever that number might be, they can coast into their retirement. This is also known as coast FIRE, but I'll talk about that in the next live stream. So be sure to subscribe if you haven't done that already. So that was the savings rate. And I completely understand that not all of the numbers here can be applicable to everybody, but just keep in mind that this is a financial independence channel. So if you feel like, man, these numbers are way too high or something like that, I never expect you to go from step 0 to 10 right away. You want to start from 1, 2, 3, 4, 5, and then eventually get to step 6. All right. So Um, okay. Now, let me go over the employer sponsored retirement vehicles. They're commonly known as the 401k, but depending on where you work, it might be called something else. And this is where the confusion comes in with a lot of people. Is the 403b the same as the 401k? How is the TSP different from the 401k? A lot of people confuse the 401k and IRA thinking that they're the same thing when they're not. And despite what people say on social media about the 401k, it is not a scam. And it is a great way to build your wealth, either tax free or tax deferred. So, let me do a better explanation than your HR did during your orientation day. So, if you work in the private sector, you should have a retirement plan offered to you, or what's called a 401k. If you don't have a 401k or any sort of employer sponsored retirement plan, then the other option is really just an IRA. An employer without a retirement plan is not really worth working for it, in my honest opinion. And if you have a 401k working in the private sector, it's not very common to have a private pension fund anymore. But if you do have one, just make sure to find out how much you could get out of your pension plan. You may even have a cash option to roll that over to your retirement account if you decide to leave the job early. So a 401k is typically offered by a private sector employer. And if you have a 403b, you're most likely someone working in a nonprofit organization like a public school, ministry, hospital, or charity. And you're most likely going to have some type of pension plan from the school or university you're teaching or the hospital you're working in. And this is something else your employer might offer, and that's the non-governmental 457 plan. So you could be contributing to both 403b and 457b at the same time. You could essentially double your retirement contributions if you're in a high income bracket. So be sure to check with your employer to find out if you're eligible to open a non-governmental 457 plan. So a 403b is typically offered by a nonprofit organization. And if you're a state or local government employee, you could have a public employee retirement system, or what's called PERS, with the state government you work for. So, for example, if you're a in California, it's called CalPERS, or California Public Employee Retirement System. If you're in Nevada, it's called MVPERS, or Nevada Public Employee Retirement System. This is pretty common for police officers, firefighters, and other civil servants working directly for the state and local government. And depending on your employer, you could have the option to open a governmental 457b plan, which is in addition to the state or local pension fund that you're going to be eligible to collect. And this is a good time for you to review your pension plan with your government employer. If you're a firefighter or police officer, you may have a really good pension program already in place. But having that 457 plan will allow you to have extra cash flow if you decide to retire early, because there's no age limit on when you can start taking distributions out of your 457b plan. So you could retire as a state police officer, and there's no 10% penalty for early distributions from a 457b plan. And if you have a TSP, there are two separate pension programs. One is for the military, and who retire from the military, and the other one is for the Federal Employee Retirement System, or a Federal Employee Pension. The military LRS and LRS stands for Legacy Retirement System, and a Blended Retirement System, or BRS. LRS is going to slowly phase out as more people who came in before 2017 retire from the military. The military members do not contribute to their pension, but they could start collecting it when they complete 20 years of active duty service. Guard and Reserve can start collecting at the age of 60 and buy back the age if they did any contingency orders. How do I know this? I'm an Air Force veteran. And the Federal Employee Retirement System, or FERS, is where federal civilian employees actually have to contribute to their pension in after-tax dollars. Their rules are much different, and I'll talk about it in a separate video. And if you're a civilian employee to the federal government, or a member of the armed forces like the Air Force, Space Force, Coast Guard, Navy, Marines, or Army, then you're going to have what's called a thrift savings plan, or TSP. It should just be thrift savings plan. It works just like the 401k, but it is by far the cheapest 401k plan available out there. But the TSP is only available for military members and federal government employees. If you're both, you could have two separate TSP accounts. And let me give you the breakdown here. Your personal contribution, or what's called an employee contribution, is limited to $23,000 for the year 2024. So this is between January 1st, 2024 and December 31st, 2024. Once 2025 hits, you can't go back to 2024 to try to max that year out. And if you're over the age of 50, you have what's called a catch-up contribution in the amount of $7,500. This will also increase based on inflation, but it doesn't happen very often. And under Secure Act 2.0, which got signed into law in 2022, starting in 2025, people between the ages of 60 and 63 can contribute an additional $10,000 to their 401k, 403b, 457, or TSP. So for your personal contribution, you can do either traditional or Roth. Some plans only offer traditional, but some plans offer both traditional and Roth. Traditional means you're reducing your taxable income now, but you'll end up paying taxes later when you start taking distributions. If you choose Roth now, then you're going to pay taxes now, and you won't pay taxes when you take distributions in retirement. What's right for you will depend on your marginal tax rate, your personal preference, and your entire financial situation. And also starting in 2026, if your income is over $145,000, the catch-up contribution, excuse me, the catch-up portion of your contribution for either $7,500 or $10,000 has to go into the after-tax or Roth account if your income is over $145,000. Congress basically raised taxes on the American people without publicly announcing it, right? But I'd be happy to do it in Roth, in my personal opinion, because I never know what our future tax rates will look like. So anyway, if your income is less than $145,000, then you have the option to do either the Roth or traditional for the catch-up contribution. This will also apply to people between the ages of 60 and 63 who wish to make the $10,000 catch-up contribution. And if you're curious about which retirement account to prioritize first, I always tell people to prioritize their employer match, Roth, and then tax deferred in that order. You should never miss out on the free money from your employer unless you don't have enough money right now to pay down your debt or put food on the table. The next priority is to max out the Roth IRA, which is a completely separate retirement account. And then the next one is to max out either tax deferred or tax-free or Roth account in the 401k. Remember the rule of 55. If you have a 403b, TSP, or 401k, you can start taking distributions from your 401k or other 401k type plans if you retire in the same year you turn 55 years old. You can't do that with your IRA. If you maximize your contributions now, your 401k can be a great weapon for your retirement journey. And if you're still not sure what you're doing, just consider joining my private client program. And you can schedule a 60-minute session with me by visiting firestation.com/consultation. And you can also download your 401k calculator by visiting firestation.com/resources. And that is completely free for you to use. All right. Now, here is, you know what? Hold on one second. Okay, cool. Making sure that the audio is still good. Audio is cutting out? I don't think the audio is cutting out. Let me know in the comment section if the audio is cutting out. Okay, now here's probably the most common misconception about the Roth IRA. It is a completely separate investment vehicle with no ties to your 401k. All right, so let's talk about the eligibility to open a Roth IRA. Anyone can actually open a Roth IRA as long as they're at least 18 years old. And if you're under the age of 18, then you need to have your parents open what's called a custodial Roth IRA for you. And regardless of your age, you just need to have an earned income in the year you want to contribute to your Roth IRA. If you have a teenager working at a fast food restaurant, your teenager can contribute to their custodial Roth IRA, and you as a parent will need to oversee the custodial Roth IRA until your children become 18. And you can even contribute on behalf of your child as long as that child has an earned income. All right. And if you're over the age of 18, you still need to have an earned income to be eligible to contribute to a Roth IRA. The other exception is if you and your spouse are filing your taxes jointly and only one of you has an earned income. So if you have a job, but your spouse is a stay-at-home parent or spouse, your stay-at-home spouse can open what's called a spousal Roth IRA to contribute the same amount to the Roth IRA as long as you have a joint household income. But as far as the eligibility to contribute directly to the Roth IRA, there are income limits set by the IRS. The reason they set a income limit is that Senator Roth at the time in Congress did not want rich people to shelter money in a tax-free retirement account. Obviously, it didn't work out so well because they found a tax loophole called a backdoor Roth IRA, which I'll talk about later on. But the bottom line is that anyone can open a Roth IRA, but to directly contribute to the Roth IRA, you need to be under the IRS income limits. And keep in mind that the income limits do change every year to adjust for inflation. And assuming that you are under the IRS income limits, here's how the contribution works. You have a checking account or a savings account where your W-2 income comes in after you pay your taxes to the government. So the IRS automatically assumes that the money in your checking account is in after-tax dollars. So when you make a transfer from your checking account to your Roth IRA, this process is called an after-tax contribution. Every dollar you put into your Roth IRA is already taxed. So the government can't tax you again, right? And that money, it just sits in the money market fund inside your Roth IRA. So this is a very common mistake people make. Once you make that transfer to your Roth IRA, there's another step that you have to take. And because that money is just sitting in a money market fund that pays you very little interest, it is not yet invested. So the next step is to invest that money in stocks, index funds, ETFs, or something that is going to grow your money. Did I already mention that your investments will grow tax-free? I probably did. But well, when that money is fully invested in your Roth IRA with an index fund or some kind of investment, then it's going to generate what's called interest and earnings. So if you contribute $7,000 to your Roth IRA and the earnings generate $500, then that $500 is going to be your earnings, right? And it is very important that you memorize these two words: contributions and earnings. Contributions are the dollars you already pay taxes on from your checking account. Earnings are what you grew or what grew from those dollars you contributed to the investments. You have to keep track of how much you contributed to your Roth IRA every single year, because you can actually take out what you contributed to the Roth IRA at any time. Not that I recommend it, but what you can't take out is your earnings and interest until you turn 59 and a half. So your Roth IRA can start to grow tax-free every single year. And every dollar you earn in your Roth IRA can also become tax-free. And when you turn 59 and a half, again, before you turn 59 and a half, the only money you can take out is your Roth IRA. In your Roth IRA is your contributions. But if you take the earnings out of your Roth IRA, then you would owe a 10% penalty, federal income tax, and state income tax if that's applicable to you. Your Roth IRA is a very powerful investment vehicle because of the tax-free growth. And that's why it is something you need to prioritize after the 401k employer match every single year until your retirement. Oh, let me show you the backdoor Roth IRA here. But what if you are above the Roth IRA income limit? You cannot directly contribute to the Roth IRA if you're above the income limit, but you can do what's called a backdoor Roth IRA. A lot of people don't understand the backdoor Roth IRA because it can be very somewhat complicated. So let me give you the complete breakdown here, right? So between January 1st, 2024 and April 15, 2025, the contribution limit for your Roth IRA, if you're under the age of 50, is going to be $7,000. That's right. You have until the tax deadline to make the Roth IRA contributions or the backdoor Roth IRA conversion. The catch-up contribution limit for those over the age of 50 is an extra $1,000. So in 2024, you'll be able to contribute up to a total of $8,000. The income phase-out range for taxpayers making contributions to a Roth IRA is between $146,000 and $161,000 for single individuals and heads of household. And if you're married and filing your taxes jointly, the income phase out range is between $230,000 and $240,000. And if you're married and filing your taxes separately, the income phase out range is not subject to the annual cost of living adjustment. So it will always be between zero and $10,000 unless Congress decides to make an amendment to change something in the future. But I will be sure to post any updates on this channel, so be sure to subscribe if you haven't done it already. Now, so if your modified adjusted gross income is less than $146,000 a year in the tax year 2024, you can directly contribute to your Roth IRA up to $7,000 or $8,000 if you're over the age of 50. That makes sense so far, right? But if your modified adjusted gross income is between $146,000 and $161,000, then you can only partially contribute to your Roth IRA, and the rest of the amount will have to be a backdoor Roth IRA. And if you make more than $161,000 a year, then you cannot directly contribute to your Roth IRA at all. The entire amount will have to be done through a backdoor Roth IRA. And if you're married and filing your taxes jointly with a spouse covered by a retirement plan at work, if your combined modified adjusted gross income is less than $230,000 a year, you can make a direct contribution to your Roth IRA and your spouse's Roth IRA, right? The partial contribution happens between $230,000 and $240,000. And if you make more than $240,000, then you have to do a backdoor Roth IRA for the entire amount. And this is how a backdoor Roth IRA works for people above the Roth IRA income limits. You still have your checking account where you normally make after-tax contributions directly to your Roth IRA, right? And this one is slightly different because you essentially you're adding an extra step to the backdoor Roth IRA process. Instead of transferring money from your checking account to your Roth IRA, you would transfer it to your traditional IRA instead. And I would highly recommend that you open a traditional IRA and a Roth IRA with the same broker. So if you already have a Roth IRA with Vanguard, then open a traditional IRA with Vanguard. So the traditional IRA income limit for non-deductible contributions as a single individual is at least $83,000. If you're married and filing your taxes jointly with a workplace retirement plan, the income limit is $143,000. And if you're married and filing your taxes jointly, but you're not covered by a workplace retirement plan, then the income limit is $240,000. You have to make sure the contributions you make to your traditional IRA are considered non-deductible or in after-tax dollars. You want the transfer to happen as soon as possible, and you don't want to invest what you put in the traditional IRA until it gets moved to the Roth IRA. That makes sense. That makes sense so far, right? And once that money you transfer from your checking account to your traditional IRA is settled, then the next step is to make a transfer from a traditional IRA to a Roth IRA. This step I just described is what's called a backdoor Roth IRA conversion. You just made an account transfer of after-tax dollars from your traditional IRA to a Roth IRA. This is what's called a non-deductible conversion. So this process is not taxable, assuming that you don't have any existing balance in your traditional IRA. So with the contribution limits in mind, if you're under the age of 50, you can contribute up to that amount throughout the tax year. And remember, the tax year is between January 1st and April 15th, or the next tax deadline. So if you're over the age of 50, don't forget about the catch-up contribution too. And whether you lump sum invest or dollar cost average your IRA conversion, this is not a taxable event because that non-deductible contribution you made to your traditional IRA is considered after-tax dollars. I can't emphasize that enough, that the IRS cannot legally tax you twice on your retirement, but you have to make sure that you file an IRS form 8606 to identify your traditional IRA contribution as non-deductible, okay? And here's what people forget to do, and that's to actually invest once the money is inside a Roth IRA. There are countless stories about how people do steps 1 to 9 and then completely forget to do step 10 and leave them wondering why the money hasn't grown at all, right? But what if you have an existing balance in your traditional IRA, all right? Then I actually don't recommend doing a backdoor Roth IRA conversion until you take one additional step, because you're going to trigger what's called a pro rata rule, and you'll end up owing federal income tax if you don't do it right. So let me explain how it works. Let's say you have $50,000 in pre-tax dollars in your traditional IRA that you rolled over from, let's say, your old 401k, 403b, or TSP, and you decide to make a backdoor Roth IRA conversion of $7,000 in after-tax dollars, right? Excuse me. And when you move this $7,000 into this traditional IRA, now you have a mix of pre-tax dollars and after-tax dollars. And when you make a transfer of $7,000 from your traditional IRA to a Roth IRA, you're going to trigger the pro rata rule, because the IRA is not going to segregate what's pre-tax and what's after tax. So in the traditional IRA, you have $57,000 total, with $50,000 in pre-tax dollars and $7,000 in after-tax dollars for the backdoor Roth IRA. So when you divide $7,000 by 57,000, that's going to be 12.3% in after-tax dollars. And when you divide $50,000 by $57,000, that's going to be 87.7% in pre-tax dollars. So when you make the $7,000 conversion from the traditional IRA to the Roth IRA, 87.7% of that $7,000 or $6,139 will become taxable income. And the remaining $861 will not be taxable, because the pro rata rule will say it is in after-tax dollars. So assuming that you're above the income limits with a 24% marginal tax rate, you could owe almost $1,500 in federal income tax for that portion of the conversion. I would not like that, right? You could also owe almost $2,000 if you're in the 32% marginal tax rate, assuming that you have a $50,000 pre-tax balance in your traditional IRA and make a $7,000 after-tax backdoor conversion. So in order to fix this, this is where the extra step comes in. You'll have to move those $50,000 in pre-tax dollars out of your traditional IRA to avoid the pro rata being triggered every time or every year you do the backdoor Roth IRA conversion. You can move those $50,000 to your traditional 401k, 403b, 457, or TSP, whoever you're employed with currently. You're not going to be taxed on the rollover as long as you move it from traditional to traditional. Once that money is out of your IRA, then you can do the backdoor Roth conversion without worrying about the pro rata rule triggering a taxable event. And just don't forget to take the final step to invest in something that is going to help you achieve financial independence and retire early. This is crucial because a lot of people end up forgetting to invest, and that's very, very unfortunate. The other important thing that you need to remember is that every dollar you invest inside your Roth IRA is going to grow tax-free. You can take out your contributions at any time, tax-free and penalty-free. But you have to remember, until you turn 59 and a half, to withdraw the earnings and interest that grew inside your Roth IRA, right? So do not forget to invest. And when you do a backdoor Roth IRA conversion, you cannot touch your money for 5 years. Now, that's a different rule. So if you make the conversion in the year 2024, do your backdoor Roth IRA conversion this year, then you can't take that money out until the year 2029. You have to understand these rules before you start investing. All right. I need some water break. Give me 1 second. And I'm going to give out some channel membership, people. Let me know if you guys are getting value out of this gift. I'm going to sip some water and I'll be right back. By the way, I am so fired up to announce the launch of my private FIRE community for people just like you and me who are passionate about investing, saving, and achieving financial independence and exploring different possibilities to retire early. My private community will allow you to connect with me on the platform and get in touch with other like-minded individuals or couples who are just as serious as you are with the FIRE movement. As a member of my private community, you'll get resources like investing, saving, paying off debt, or finding the right place to grow your money. For for a very limited time. Please enjoy the free trial by clicking the link in the description below. Okay, I think I just answered this person's question. Hopefully, I don't know if you're still watching this. What if you're ineligible for a Roth IRA due to income? So I just explained the entire thing about the backdoor Roth IRA. If you missed that, hopefully you can rewind it. If you're watching this on replay, I should have left the timestamps in the video already. So you can go in there and take a look. Did a pretty detailed dive on that. And let's hit that like button. I love it. Jesus, appreciate you being here as always. So let's see. Cool. Yeah, it was magical, wasn't it? Yeah, I timed it. I just knew that person was going to ask me. That's why I did it. And see, yeah. So, like like Ian said, just look into the backdoor Roth IRA and see if it makes sense for you. And this is being live streamed to Instagram and Facebook. So many platforms right now, so I have to make sure that I get the Instagram questions and some no Facebook questions too. Get a lot of those private messages. All right, cool. All right, got my let me see who got the membership. Cool. Attorney Aviator. He's always here. How's it going? All right. All right. So here's a very powerful savings account that only about 10% of Americans use as an investment vehicle. And that is the health savings account, or HSA. Your HSA can become an early retirement account if you understand, if you understand how to maximize your investments. I want you to become the 10% of people who use HSA as a powerful investment vehicle. Okay. And unlike the Roth IRA, there's no income limit to your HSA. There are two ways to contribute to your HSA. And one way is to come out directly out of your paycheck from your job. The other way is coming directly from your employer. Depending on your employer, they could give you a lump sum contribution at the beginning of the year or make small deposits every pay period. Having an employer contribution can help because it counts towards your personal contribution limit, unlike the 401k. So, and if you're on a, let's say, family plan with a maximum contribution limit of $8,300 and your employer contributes $1,000 to your HSA plan in the same year, then you only need to contribute up to $7,300 because the contribution limit is a combination of both you and your employer. Once the money goes into your HSA, you actually have two separate pots of money inside your HSA. And one of them is in cash sitting in that HSA checking account, which is meant to be used to pay medical expenses. A lot of HSAs require you to have a minimum cash amount before you move it into your investment account. Some HSAs require you to have say $1,000, $1,500, and some may require you to have $2,000. And once you reach the minimum cash threshold, you can invest anything above that amount into the brokerage account. Some HSAs will have limited options for you to invest, but some HSAs like Fidelity, Schwab, Vanguard will give you, I'm not sure Vanguard has that actually, will give you a wide variety to choose from individual stocks, ETFs, and mutual funds. But because HSA will grow tax-free, this is a great investment vehicle to invest in something that would be less tax efficient in a taxable brokerage account, because the dividends and capital gains will not be taxed under your HSA. And remember that the HSA contribution period is the same as the Roth IRA. For the tax year 2024, you can contribute $4,150 as a single individual or $8,300 for the family plan until the tax deadline on April 15, 2025. And starting on January 1st, 2025, you can contribute $4,300 as a single individual or $8,550 for the family plan until the tax deadline on April 15, 2026. If you're over the age of 55, you can contribute an extra $1,000. And here are the differences between an HSA and Roth IRA, and why I prioritize HSA first. The HSA allows you to make pre-tax contributions, which means it will lower your taxable income every year and potentially saving you hundreds, if not thousands, in federal and state income taxes every year. If you're a California or New Jersey resident, unfortunately, you're not going to get to reduce the state income tax deduction, but you will still get the federal income tax deduction. Okay. But anyway, Your employer could also give you a contribution to the HSA. You have to deduct the employer contribution, like I said earlier, from your personal contribution. There are no income limits, and you don't need to have an earned income to contribute to your HSA. You just need to be enrolled in a high deductible health plan. And if you directly contribute out of your paycheck, you get to skip out on the Social Security and Medicare taxes on the contributions. That's why I call the HSA a quadruple tax advantage account. When you start investing, your HSA will grow tax-free inside your HSA and reimburse yourself at any time as long as you have the medical receipts to provide proof of medical expenses. After age 65, you can use the HSA for anything and not owe the 20% penalty, but you will owe income taxes on the non-medical distributions. What's nice is that I get to use the HSA on Medicare premiums, deductibles, and copays when I'm 65. And what I cannot do is to contribute to the HSA and be enrolled in Medicare at the same time, right? And for the Roth IRA, the contributions have to be in after-tax dollars from your checking account. So if you compare it with the HSA, you don't get your taxes reduced from the contributions, but you do get to double your Roth IRA contributions in two separate accounts if you're married and filing your taxes jointly. With the Roth IRA, you don't get an employer match or employer contribution, but the investments inside the Roth IRA will also grow tax-free, just like the HSA. And when it comes to that withdrawal rule, the HSA is stricter than the Roth IRA because I need to provide proof of medical expenses in order for those withdrawals to be tax-free, right? But with the Roth IRA, I can withdraw what I contributed to the Roth IRA at any time, tax-free and penalty-free, without providing any justifications. I cannot do that with my HSA because it's in pre-tax dollars. What I cannot withdraw from my Roth IRA until I turn 59 and a half is the earnings and interest that accrued inside my Roth IRA. So for example, if I contributed $7,000 this year and earned $500 in dividends and earnings, then $7,000 is what I can withdraw at any time, tax-free and penalty-free. But $500 is what I have to wait until I turn 59 and a half. And the other thing to keep in mind is that if you use your HSA for any non-qualified medical expenses, the IRS will penalize you 20% and charge you both federal and state income taxes. If you take out the earnings of your Roth IRA before you turn 59 and a half, the IRS will penalize you 10% and charge you both federal and state income taxes. I hope the chart that I just showed you can clear things up when you try to compare a Roth IRA to an HSA. When you're completely out of debt and have the cash reserve to cover any emergency expenses, get your 401k employer match, max out your HSA, and max out your Roth IRA. You just let your investments do the rest. All right. Now, when I say let your investments do the work for you, it means you want the money to start working for you. And I'm going to explain what that means. Okay. And some of you watching this are brand new to investing in the stock market. And I want to go over some of the most basic terms just for a few minutes. Okay. Oh, excuse me. Man, I'm talking too much today. So we're going to have some fun today. And I'm going to show you guys some of this. Okay. When you own a stock, you own a very small piece of the company. This is also known as equity. A stock represents partial ownership of the company. And I'm going to use Apple as an example. And Apple has 15.2 billion shares outstanding. And when you own 100 shares, you still own a very tiny piece of Apple as a shareholder. If you own more than 50%, you say you're a billionaire of a company's outstanding shares, then you become a majority shareholder. And the stock prices change, right, every day, primarily based on supply and demand. And when people, let's say more people buy a stock than sell it, then the demand is higher than supply and the price increases. If my business is a publicly traded company on the New York Stock Exchange, if you and a bunch of people decide to invest in my company stock, then the stock price will increase. If my company reports quarterly earnings that both my revenue and net profit have increased, and my company guidance is that it's going to be even better than expected or better than the current quarter, then investors will buy more shares because before the demand increases, right? There's a lot more to the fundamentals of stock market investing, but I want to make it as basic as possible to help you understand what a stock does. All right. So I'm going to pull up the Meta stock here. Let me use Meta stock as an example. And this is not in any form of personalized financial advice. This is for educational purposes only. I would never tell you to trade a stock because that's not my job. You have to make your own financial decision. So, anyway, let's go over some of the most basic terms. Previous close means that that's the price that closed out in the previous trading day. And one, oh my gosh. Oh, gotta stop talking. I got to take a break too. All right. So now open means that that's the price that opened in today's trading day. Bid is what investors are willing to pay for a stock, and ask is what investors are selling the stock or looking to get for their shares. Okay. Days range is the stock price from lowest to highest during the day. The 52-week range is the stock price from lowest to highest and during the whole year dating back 52 weeks ago. You probably hear on CNBC or Bloomberg with something like this stock is at a 52-week high or this stock is at a 52-week low. And that's what this shows the investors. Volume is how they measure the number of shares traded in the stock. When you look at the average volume here, okay, and it says 13, almost 14 million here. If today's volume was, let's say, lower than the average volume, then it means there aren't fewer trades happening during the day. It's an important indicator to measure any significant market move. And this is Meta's market cap as of today. And that's how investors value the company's worth. Just keep in mind that Yahoo Finance doesn't always show the most accurate market cap. So if you really want to nerd it out, you can make the calculations yourself by calculating the total shares outstanding and then multiplying it by the share price. Beta, a lot of people ask me what beta is. Beta is a measure of the stock volatility. If it has a beta of 1.0, then the price activity is correlated with the market. Okay. If it's less than 1, then it's less volatile than the market. If the value is greater than 1, then it is more volatile than the market. The PE ratio stands for the price to earnings ratio, and it is a tool that can help you compare the valuations of the stock to other similar stocks. So in this example, you'll just look at the price per share divided by earnings per share. If the share price is $100 and the EPS is $10, then the PE ratio is 10, right? And keep in mind that the PE ratio will change on a day-to-day basis because the stock's price changes throughout the trading day. The EPS will only change once per quarter when the company earnings are released and filed to the SEC. So bottom line is that the PE ratio can tell investors how expensive or cheap a stock is compared to its earnings or profits. It wouldn't be ideal to let's say compare this stock to another stock in a different sector, right? And again, EPS stands for earnings per share. When you see a positive EPS, then that means the company is profitable. If you see a negative EPS, then the company is not profitable yet. EPS is a company's net profit divided by the number of common shares it has outstanding. And earnings date, pretty self-explanatory. Earnings date is the next earnings call for this stock. And forward dividend and yield are calculated by dividing a year's worth of future dividend payments by a stock's current share price. An ex-dividend date means that you have to buy the stock by this date to get the next dividend payment. There are 4 stages a company goes through when they pay dividends to their shareholders. And I talked about this in the dividend investing live stream a couple months ago. Declaration date is the date the company announces that it will be issuing a dividend in the future date. Record date is when the company looks at its current list of shareholders to determine who will receive all the dividends. An ex-dividend date, what you're looking at right now, is the date the company determines which of their shareholders will be entitled to receive the dividend. And only those shareholders who hold a company stocks or a company stock prior to the date are entitled to receive the company's dividends. And payable date, you're not seeing that here. Payable date is the payment day, and that's when the company pays out the dividend to the eligible shareholders. And the next one is 1-year target estimate. What that means is that Wall Street analysts are predicting what the stock price will be a year from now. And just keep in mind that price targets are almost never and never accurate. And I never take their price targets very seriously. But anyway, I'm not by any means encouraging or recommending you to buy individual stocks, but I think it's important for you to understand the basic fundamentals of company stock before you start investing. If you're getting a lot of value out of this, let me know in the comment section and subscribe for more content. And the next one I want to talk about is ETFs, just real quick. So now that you have a good or somewhat of a good understanding of a stock, should you invest in a mutual fund or an ETF? I'm only going to go over index mutual funds or index ETFs. You'll have to do your own research about the actively managed funds because I'm not here to sell anyone's investment products. An index mutual fund or index ETF tracks the performances of a specific market index or benchmark like the S&P 500, Dow Jones Industrial, Russell 2000, and many more. And neither index mutual fund or index ETF is trying to beat the market, but instead they just ride with the market. If the S&P 500 goes up, then the index fund will also go up. If it comes down, then it will also come down. So let's do a detailed comparison between some of the index funds. So when I first buy an ETF, there's no minimum initial investments like the mutual fund. Some index mutual funds like Schwab and Fidelity don't even require minimum investments, but Vanguard index mutual funds will require, say, $1,000, $3,000, and sometimes $10,000 or more to open an index mutual fund. It just depends on who your broker is for your Roth IRA, HSA, or taxable brokerage account. And fractional shares are they're limited to certain brokers. And keep in mind that these rules are subject to change depending on when you're watching this video. But at the time I'm recording this video, some brokers will allow you to buy fractional shares. And as you can see, many brokers now, not some, are allowing you to buy fractional shares, and some brokers won't. For mutual funds, after the initial investments, your minimum investment needs to be at least $1. So let me give you a quick example. If one share of an ETF is $300, and if my broker allows me to buy fractional shares, that means I could buy a fractional share of 0.1, 0.2, or 0.5 shares if the broker allows me to, right? Half a share would just cost me $150 in this scenario, right? And which is helpful, especially if I'm only contributing $100, $200, or $300 every time. So if I'm just starting to invest, and the mutual fund I really want to buy will cost me $3,000 to open, then I would probably start with an ETF first until I get to $3,000. This also depends on the type of investment vehicle I have. And an ETF might be a better option for you if I'm, say, or I should say for me, if I'm looking to buy it with a specific share price that I have control over. Maybe I don't want to buy an ETF at $300 a share because I feel like it's overvalued, or so maybe I want to wait until the ETF drops to 290 so that I can maximize the return. A mutual fund, on the other hand, processes the trade after the market closes. So if I bought $100 worth of mutual funds right now, then the order will be processed after 4:30 p.m. Eastern Standard Time. But I don't have any control over the share price or the net asset value I purchased with a mutual fund. And with the ETF, I could have the option to do the market order or the limit order. If I want to keep things simple, I could just do the market order. So I just buy shares with the best current price without complicating anything. If I want to buy an ETF at a cheaper price, I could buy 10 shares of for $280 in limited price order, which would cost me $2,800. It's really just up to my investing preference. I could even submit a limit order of between 60 and 180 days, depending on the type of broker I have. The downside of doing a limit order is that the share price may never come down to $280 within the time period that I dictate. If I'm investing it for the long term, I just stick to the market price. But if I'm just buying an index mutual fund, and I'm going to use a Vanguard S&P 500 index mutual fund as an example, I could just put the dollar amount in here without worrying about how many shares I want to buy. If I had $200, but the S&P 500 share price is $400, then Vanguard mutual fund will automatically calculate my purchase price to 0.5 shares. So the only downside of a mutual fund is that I don't get to dictate the share price because the trade execution doesn't happen until after the market closes. So I'm going to get the same share price as everyone else who bought and sold the same mutual fund on the same day. And if I'm the type of person who wants to set up automatic investments every week, every 2 weeks, or every single month, then I wouldn't choose any index ETFs because I can't make automatic investments or withdrawals. Some brokers might allow you to, but uh, most brokers don't, right? Unless you have something set up with your broker for the ETFs. With index mutual funds, I can set up automatic investments and withdrawals in and out based on my preferences. It is one less step I need to worry about if I have my automatic schedule set up, right? So, when should you invest with ETFs or index mutual funds? If you really enjoy trading and bargaining for a better share price when the market is open, then doing the ETF might be the right option for you because ETFs can give you up-to-date information on the share price when the market is open. But index mutual funds only let you buy and sell after the market closes. But if you're looking to invest long-term for your retirement, then index mutual funds could be right for you because you're not looking to buy or sell when the market opens. And it also makes automatic investing so much easier. When it comes to my taxable brokerage account, I find the ETFs to be much more tax efficient than my mutual funds because ETFs don't trigger capital gains taxes when other investors cash out. But generally speaking, both index ETF or index mutual funds have been good for my taxable brokerage account because the turnover rate inside the investment is much lower than the actively managed mutual fund or ETF. So the bottom line is that I enjoy investing index mutual funds in my Roth IRA and HSA, while I enjoy investing in index ETFs in my taxable brokerage account. Is it a deal breaker if I did it the other way around? Of course not. What matters is that I am investing and I am putting my dollars to work, right? All right. What has it been? It's been an hour. Cool. So I do want to talk about one more thing here. So now that you have your bank account linked to your investment account and you have chosen the index fund you want to invest in the long term, the next step is to automate your investing. And I know you probably think this is such an easy step to do. Why am I talking about this? But you'd be surprised to find out how many people forget to invest because they don't know how much they need to contribute every time they get paid. So I'm going to show you this here. And these are the most common paycheck frequencies. And you get paid every 2 weeks on the 1st and the 15th or once per month. Biweekly paychecks are the most common frequency found among businesses. And about 40% of private businesses and public sectors pay their employees every 2 weeks. So I'm going to go with that. All right. So if you get paid every 2 weeks, you're going to have 26 pay periods or paychecks in a year. In some years, you're going to have 27 pay periods, and that can happen when the number of days in a year is not evenly divided by 14 days. But anyway, that's really some nerd stuff. But if you're looking to max out your 401k in a year, you can use Excel to calculate the maximum contribution limit and then divide it by 26 pay periods. I'm going to drop this for the private community members and the course members. Okay. But what if you're late to the game and trying to max out your contribution in the middle of the year? You can just divide the contribution limit by however many pay periods you have remaining for the year, right? So if you have 20 pay periods remaining instead of 26, then you're going to divide it by 20 and subtract however much that you have contributed so far. That makes sense so far, right? And if you get paid on the 1st and the 15th, you're always going to get paid 24 times a year. So your contribution amount will be slightly bigger, but it will be the same at the end. And it's much predictable. Much better at scheduling. Anyway, and if you're trying to max out your Roth IRA every year from January to December, then you would just divide the maximum contribution limit by 24 pay periods. And that's going to get you to the maximum limit. And if you're trying to figure out how much you can contribute every month, just put the amount at the top here and it's going to calculate it for you. How much and you're going to find out how much you can contribute in total every year. Investing just $100 a month can make a difference. What you want to do is to increase your contribution little by little if you can't afford it yet. If you get a 5% pay increase next year, then increase your savings rate by, let's say, 3% and use the remaining 2% to pay for your expenses. And these are the investment vehicles that you can automate your savings and investing. And I've been automating everything since 2017. And it's nice to just not worry about it at all. And 401k is deducted directly from your paycheck. And your employer can give you profit sharing or employer match. Your 401k is probably by far the easiest investment vehicle to automate your contributions. The 401k website will ask you to contribute in dollars or in percentages. And if you're looking to max out your 401k contribution, then it is better to just contribute in dollars, not in the percentage. If your paychecks aren't enough to max out the 401k yet, then just do the percentage like 15, 20, or 25%. It depends entirely on your current financial situation. If you have any high interest debt, just do the bare minimum contribution up to your employer match. If you don't get an employer match, then just skip 401k for now, right? And you're going to have to manually schedule your automatic contributions with your Roth IRA. You have to make sure you have an index fund already invested before you can automate your contributions. Your 401k already has a list of mutual funds to choose from, but you have to make your own selections with your Roth IRA. If you do an S&P 500 index mutual fund, then you have to first invest it and then do the automatic contribution schedule. Your HSA is best if you deduct it from your paycheck to enjoy pre-tax contributions, which include Social Security and Medicare taxes. Your employer can also give you a match if there is one. So be sure to contact your health insurance company about the match. You can also contribute from your personal checking account, but keep in mind that you won't get to enjoy the tax deduction right away if you contribute directly from your checking account. You will have to wait until you file your income tax to get that tax refund. And when it comes to your taxable brokerage account, it works the same as your Roth IRA because you're contributing to it in after-tax dollars. And then your cash reserve, like your emergency fund, annual expenses fund, discretionary fund, travel fund, and other sinking funds to save for a home or a vehicle will come directly from your checking account. It should be very easy for you to schedule your automatic contributions if you have accounts in the same bank. So think of automated investing like automated bill pay. If you know how to set up an automatic payment for your mortgage, cell phone, or utilities, then you can easily learn how to set up automatic investing. You have to remember that every investment vehicle has its own characteristics. Your 401k and HSA can be in pre-tax dollars, but your Roth IRA and taxable brokerage account have to be in after-tax dollars. Automated investing is a good idea for everyone because you're always buying into your investments no matter what the market does. Your dollar cost averaging into your investments based on your paycheck frequency. I'm never timing the market. I am always buying into the market. Okay. So, and let's just say you have been investing for a while and you log into your investment account and you see unrealized gains and you see another option that says realized gains. This is how you look at your investment portfolio. And this is an example of unrealized gains. This doesn't belong to anyone's portfolio. I'm just using it as an example for educational purposes only. And if you look at the ETF here, this is the ETF. That is this one here is the total cost basis, or that's almost $8,500. And the market value on the left side here is 82.85. So if you look on the far right side here, it says that there's a total loss of 2.39% in unrealized losses. So this ETF on paper has lost value since the investor purchased the ETF. And if you look at the next one with the mutual fund, the investor's cost basis is $18,600. So that's how much money they put into the mutual fund, right? And if you look on the left side, it has a gain, or the market value is $18,993. So that gives the investor an unrealized gain of 2.12%. Why is it unrealized? Because the investor has not sold anything yet, right? So on paper, the investor has an unrealized gain of 2.12%. That makes sense so far, right? So what do unrealized, or I'm sorry, what was our next one? Okay. So what do realized gains actually look like? So let me show you some examples. Let's say the investor sold out a stock, ETF, or mutual fund for $7,200, but the cost basis was $15,000. Then the investor has a realized loss of 52%. Yikes, right? Out of that total losses, this investor had both long term here and the short-term positions. So long-term positions are the shares they held for at least a year. Short-term positions are the shares they held for less than a year. The tax implications are entirely different between these two. So the long-term capital gains taxes, they are taxed at 0, 15, or 20%. Short-term capital gains tax are taxed just the same as federal income tax at 10, 12, 22, 24, 32, 35, or 37%. It is a very crucial, it's very, very crucial that you know how long you've had the investments before you decide to sell, or you're going to have a headache during the tax season. But what if you sold a stock at a pretty good gain? You put $7,000 into it, and then you sell it for $8,285 with a total of almost 17% in capital gains. But only 3.91% of that is considered long-term capital gains. So that's going to be taxed at 0, 15, or 20%. And the rest of 23% there is in short-term capital gains and could be taxed up to 37%, depending on your marginal tax rate. So again, you have to keep in mind that these are just examples and they don't belong to anyone's portfolio. Brand new investors tend to forget that they don't lose money until they actually sell. If you see something at a loss on paper, please don't be discouraged, especially with an index fund inside your retirement account. Just continue to buy and let the time do the rest for you. You can't possibly achieve fire if you're always fearful of what your investments might do today or tomorrow or next week. You have to be strategic with your portfolio to make sure it is going to meet your long-term goal, right? You have to be tactical with your investments to make sure they're balanced based on your risk tolerance. Trust me when I say that my first year of investing was just as chaotic as yours, because I didn't know where the market was taking my investments. You are working hard right now for that money to go into your account so that one day you don't need to work again, because your money is going to end up working for you. Your time is valuable. So don't waste another minute being indecisive due to analysis paralysis. Start investing today, right? And this has been another beast of a video, and I hope you got a lot out of it. That was a beast of a video, man. A lot of info. Okay, so let me go through Q&A just real quick. See what's going on in the market. I'm kind of curious what's on. Well, the stocks are kind of flat, I guess. Not sure what's going on. It's up about 1%. I'm going to Yahoo Finance. No, it's actually down about 0.5%. Yeah, the stock market crash on Monday from Japan, that really took a hit. And I had an unscheduled live stream on Friday when the jobs report came out. And I'm going to be live streaming again on Wednesday when the CPI comes out. Oh, Wednesday from today, so a week from today. That's going to be very interesting to see where our inflation is going to take us. I know at Wall Street, some of the guys are talking about the Fed possibly having an emergency meeting to talk about cutting interest rates right away. I don't see that happening. I think we need to see probably another unemployment data for them to kind of like panic, and for the Fed, because it'll take Fed like snap of a finger, to just start cutting interest rates right away. They could start cutting interest rates by 50 or 75 basis points. So that's going to be pretty interesting to see. I'll answer a few questions. I don't want this live stream to be too long, but okay. Okay, this person's asking me, how should I best set up my kids' financial future? Okay. So you don't have to have like a lot of money to write a will, but if you don't have a will, please at least write one. Um, Having a will help your loved ones take care of you after you pass away. So if anything, I would write a will first. It doesn't have to be fancy. Just type it up and let someone else know that you have a will. Okay. If you have, like, let's say about $750,000 in net worth, or let's say you have $1 million in net worth, I would advise, and this is not financial advice from me, but I would encourage you to talk to a estate attorney and possibly set up a living trust. Okay. And I'm not here to sell any products, but having a living trust, you can avoid probate. And having a trust will avoid your assets and information becoming public in a court that process probate. And personally, I would rather not have my information in public, letting everybody know what I had, or what I want to do for my with my stuff. If something were to happen to me, I want that to be private. So it does cost money to set up a living trust, but if your net worth is going up there, I would highly advise you to talk to an estate attorney to possibly set up a living trust to kind of protect your privacy, right? There are videos about celebrities when they passed away. Um, I think Robin Williams, when he passed away, he had a trust, so his stuff was really protected. And then another celebrity who passed away only had a will, and he had like his information was public, right? So that's something to possibly look into. The other thing you should do is really update your beneficiary. A lot of people forget about doing this. Is all you have so many bank accounts. Some of the things that so you have your bank checking and bank savings. Log into your banks and just update your beneficiary. Okay. So beneficiary will be, let me update beneficiary. Okay. So all of your bank accounts. If you're married, if you don't have a beneficiary set up, it should automatically go to your spouse. And if you're like, the other thing is, if you're in the process of a divorce, then you should probably start going in there and start updating your beneficiary. Because if you're going to be divorced soon, then that's something that you don't want to have your soon to be ex spouse to have any of your retirement, right? Roth IRA, and log into your 401k. You can update your beneficiary there too. HSA, same way. What are the other accounts? Your taxable brokerage account, just depending on how your brokerage account is structured. If it's already kind of like a joint account with your spouse and you have a 50-50 ownership, just take a look at your documentation on how that's going to happen. Like if you pass away, does your living spouse going to take over your entire account? And why is this visible? Sorry about that. All right. I didn't mean to have that message visible. I probably hit something here. But when you look at your taxable brokerage account, just see how your money and your that account is structured. Okay. And what would be the other accounts? If you have like any minors, maybe update your beneficiary to make sure that you're. That's the other thing is, your life insurance policy going to your minor might become a problem because they're not of age yet. So maybe setting up a trust might be the best way to go. So like having the life insurance policy going into the living trust, and then have the trust take care of the kids if they're under the age of 18, so that you can have like a detailed instruction in the trust. Like let me give you an example. Like if you don't want your kids to touch any of the money until they go through a financial literacy course, they don't get to touch the money unless they pass a drug test or something like that. That can all be in the trust, and with the directions, under your directions, after years of, so you passed away years ago, you can still do that. But the other really important thing is maybe financial education, right? So while you're still alive and you have kids living in a house,
I would say wait until the kids are like 7 or 8. I would say 8 years old. Then you can kind of start talking about the basics of money. This is how you spend money. This is how you save money. If you earn $100, then save half and spend half, that type of thing. And don't be afraid to just kind of take your kids to walk them through the registers. I did that with my 12-year-old when she was like 7 years old. And I was like, um, hey girl, here's a debit card, or I just gave her cash when she was 7. We went to Target, and she went to the checkout line to buy this little toy that was like $10. And I was like, all right, how much is it? And she's like, all right, it's $9.99, Dad. I was like, good. Now go to the register and I want you to pay for that. And then when they ring it up, it turned out to be $10.81. She's like, but it said $9.99. Why am I paying more? I had to explain all the sales tax and all that. And she was, at that point, she was like, man, I hate taxes already. I was like, that's my girl. She's already realizing that there's sales tax and all that gets added. And she really learned about inflation over the last couple of years because, that was all, that was always on the news, like inflation this, inflation that. So explain that to her. You don't have to be like a professional accountant, or you don't have to be a millionaire to teach your kids that concept of money. I don't think you have to explain to your kids if you're like struggling, right? That's not something that maybe you don't want to tell your kids to make them feel scared or anything like that, but just make them aware of the concept of money could help them, right? And this is something that you can set them up for success, is that just talking to them and say, this is money, this is savings, and this is investing. And I know the question you asked was, how do I set up my kids for success? And the other one you can probably think about is, what investment account you could have for your kids, like 529 college savings plan. You have the UPMA and UGMA. And you have, if your kids are like in their teenage years, you can do custodial Roth IRA. And what you can do is, like, let's say if my daughter starts working at McDonald's, right? And she earns, I don't know, $10,000 from working 3 months of summer. And I can say, hey, girl, listen, you've done a great job, working at McDonald's or whatever, the fast food restaurant, you earn 10,000. If you put half, or say you put 4,000 in your 3,000 in your Roth IRA, I'm going to put the other half into your Roth IRA. That's something that can encourage your kids to start, saving for retirement. That's not a good way to do it. Now, this is kind of a random thought, but the Secure Act 2.0 really kind of made 529 really awesome, because the 529 now allows you to roll that over to a Roth IRA, your kid's Roth IRA, or the beneficiary's Roth IRA. So let's say your kid turns 21, 22, finishes college, and you have like $35,000 remaining in the. Let me erase the rest so I don't confuse you. So you have 35K. That is the lifetime limit for 529 to Roth IRA rollover. Okay, so that is the maximum that you have, but you also have to have at least 15 years for your account to be open, your 529 account to be open. And so let's say your kid turns 24 and you want to transfer that, so that 35,000 can move from 529 under that person's the same beneficiary to the beneficiaries, I shouldn't say beneficiary, the kids Roth IRA, not custodial, Roth IRA. Okay. And what you cannot move out of that 35,000 is anything that you contributed over the last 5 years. That would be the exception. Okay. So keep that in mind. But you can move 35,000, up to 35,000, from the 529 to your kid's Roth IRA. And that in that same year you make the Roth IRA rollover, your kid cannot contribute to the Roth IRA in that year. Have to wait until the next year, the following year, to make the Roth IRA contribution. So keep that in mind. But this is a really good way. Like, if you don't know if your kid's gonna go to college, this is a great way to just say, you know what, I'm still gonna put in the 529, and if my kid doesn't go to college, I can still move that over to my kids' Roth IRA in the future. So when Secure Act 2.0 was it got passed, that was one of the great benefits that came out. It's already in effect as of January 2024. So take a look at the 529 to Roth IRA rule. It can be very, very beneficial for your kids. So your kids' future. Appreciate the question. I know that was a lot of things, but I'd love to talk to you about it. You can go to firesession.com/consultation and schedule your next session. Okay. Uh, hmm. Okay. Yeah, I can talk about that. Um, no, I don't want to talk about the elections. That's all on you guys. Yeah, this is a very politically neutral channel, so you're not going to find out who I'm voting for. What is that from? Facebook? Yeah, you're not going to find out who I'm voting for and or how I feel about politics. That's all going to be kept to me, to myself, and that's that. If it's anything politics, I'm only going to talk about it. Just finances, finance related, taxes, tax codes, all that stuff. But other than that, no, I'm not going to talk politics on that. All right. But anyway, I hope you guys got a lot of value out of this. And, I'm going to put timestamps in the live stream and hopefully it can help you get started at least. And I know there's a lot to it, but just feel free to go to firesetchat.com/resources to download the spreadsheets, calculators, and all that. Those are free. Some of the resources that I showed during the live stream, that's only going to be for the private members in the private community. So if you do want to sign that up, you can go to firesession.com/community to get a free trial. And it's really cheap compared to any other plans that I have. So I really hope that you get to just join my community and go from there. But anyway, I will be live stream again next Wednesday. And that's going to be first thing in the morning about the CPI. So till next time.